Welcome to Investor Web, where we unravel the complexities of the investment world, one video at a time. Our mission is to demystify the often intimidating landscape of finance and investment, providing clear, concise, and accessible content. Whether you're an industry veteran or a curious newcomer, we've got a wealth of insights waiting for you. From stocks and bonds to real estate and cryptocurrencies, we cover it all. Today, we will delve into the fascinating world of hedge funds and explain how they make money. To understand how hedge funds make money, it's important to first understand what they are. In essence, a hedge fund is a pooled investment structure where a group of investors entrust their money to a fund manager. This fund manager, who is often a seasoned expert in financial markets, then uses a variety of sophisticated investment strategies to try and generate high returns. Hedge funds differ from other investment vehicles like mutual funds or exchange-traded funds in several ways. For one, they have more flexibility in their investment strategies, often taking on more risk in search of greater rewards. They can invest in a wider range of assets, from stocks and bonds to commodities and derivatives. Plus, they often use leverage or borrowed money to amplify their potential returns. Now that we understand what hedge funds are, we can explore how they make money. Hedge funds are structured in a unique way which allows them to generate significant returns. Let's delve into the fascinating structure of hedge funds. A hedge fund at its core is a pooled investment vehicle. It's a pot of money contributed by multiple investors and managed by a professional investment manager, often referred to as the hedge fund manager. The manager's role is critical, as it's their responsibility to make sound investment decisions that will yield substantial returns for the fund's investors. The investors, on the other hand, are typically high net worth individuals or institutions like pension funds or universities. They're attracted to hedge funds by the potential for high returns that can outpace traditional investment avenues. However, these returns come with a higher level of risk, making hedge funds a somewhat controversial investment choice. But what makes hedge funds stand out from other pooled investment structures like mutual funds or ETFs? Well, one key difference lies in the flexibility afforded to hedge fund managers. They're not restricted to a specific type of investment or strategy. They can dabble in a wide array of financial instruments, from stocks and bonds to currencies and derivatives. This flexibility allows them to employ complex strategies like short selling or leverage to amplify their returns. Hedge funds also typically operate as limited partnerships, with the fund manager acting as the general partner and the investors as limited partners. This structure means that while the investors' losses are limited to their investment in the fund manager has unlimited liability. This arrangement encourages fund managers to be prudent in their investment choices. Another unique feature of hedge funds is their compensation structure. Fund managers usually receive a management fee, typically 2% of the fund's assets, and a performance fee, often 20% of the fund's profits. This 2 and 20 structure aligns the interests of the fund manager with those of the investors, as the manager's earnings increase when the fund performs well. In essence, the structure of hedge funds, with its blend of flexibility, limited liability for investors, and a performance-linked compensation structure for fund managers, is instrumental in their potential for high returns. This structure is key to how hedge funds make money. Hedge funds employ a variety of investment strategies to maximize returns. Let's delve into a few of these strategies. One of the most common is the long-short equity strategy. In the simplest of terms, this strategy involves buying stocks expected to increase in value, going long, and selling those anticipated to decrease in value, going short. This dual approach provides a cushion against market volatility, aiming to generate positive returns irrespective of the market's overall direction. Next, we have the market-neutral strategy. This method aims to exploit investment opportunities in specific stocks while mitigating any broad market exposure. In essence, it's about removing the noise of the market and focusing on individual investment potential. This strategy often uses a combination of long and short positions to create a market-neutral portfolio, hence the name. And then there's the global macro strategy. This strategy is for the big-picture thinkers. It involves making investment decisions based on a broad understanding of macroeconomic trends around the world. These hedge funds might invest in various asset classes, ranging from currencies to commodities, depending on where they see potential market shifts. Let's not forget about event-driven strategies. These strategies seek to capitalize on price discrepancies that may occur before or after a corporate event, such as a merger, acquisition, or bankruptcy. By predicting the outcome of these events, hedge funds can position their investments to profit from the resulting market movements. Finally, we have quantitative strategies. These are strategies that use mathematical models to identify investment opportunities. They're often automated and rely heavily on complex algorithms and high-speed computers. These are just a handful of the myriad strategies employed by hedge funds. Each one comes with its own set of risks and rewards, and it's the fund manager's job to decide which strategy or combination of strategies is best suited to their fund's objectives and their investors' risk tolerance. These strategies are what allow hedge funds to make money regardless of market conditions. Hedge funds make money in two main ways, through fees and through performance. Let's delve a bit deeper into these aspects. Firstly, we have the 2 and 20 fee structure. This is a prevalent model in the hedge fund industry. The 2 represents 2% of the total asset value that the hedge fund manages. This is known as the management fee. It's a fixed income that the fund managers receive annually, regardless of the fund's performance. So, if a hedge fund is managing assets worth $1 billion, the management fee would be $20 million. It's quite a tidy sum, isn't it? Then we have the 20. This refers to 20% of the fund's profits, known as the performance fee. This fee is only applicable if the hedge fund makes a profit. So if the same hedge fund made a profit of $200 million, the fund managers would receive an additional $40 million as their performance fee. However, it's worth noting that some hedge funds have a hurdle rate. This means they must achieve a certain level of profit before they can charge a performance fee. For example, if the hurdle rate is 5%, the fund needs to make profits exceeding 5% of the total asset value before the performance fee kicks in. Now, on to the second way hedge funds make money: through investment gains. The hedge fund's primary goal is to generate high returns on the capital it manages. It does this by using a range of complex investment strategies which we discussed in the previous scene. If these strategies are successful, the fund's assets grow, and so does the 2% management fee. By using their unique structure and strategies, hedge funds can generate significant returns for both investors and fund managers. But remember, high reward often comes with high risk. So always do your due diligence before deciding to invest in a hedge fund. While hedge funds can be lucrative, they also come with their own set of risks. As we delve into this world of high-risk, high-reward investments, it's crucial to understand that the potential for large losses is ever present. This is mainly due to the aggressive investment strategies employed by hedge funds, which can lead to significant losses when market conditions don't play out as expected. Another key consideration is the lack of liquidity. Hedge funds often require investors to commit their capital for extended periods, sometimes as long as several years. This lockup period can pose a serious problem if you need to access your money in a hurry. It's a classic case of the illiquidity premium. The potential for higher returns comes with the trade-off of reduced access to your funds. And let's not forget about regulatory scrutiny. While hedge funds are subject to regulations, they operate in a somewhat grey area of the financial world. This means they're often under the watchful eye of regulatory bodies, which can lead to potential legal complications. Lastly, it's important to note that hedge funds are not suitable for all types of investors. They're typically reserved for accredited investors, those with a high net worth or substantial income. This is due to the complex and risky nature of the investments involved. So there you have it. It's important to carefully consider these risks before investing in a hedge fund. Remember, when it comes to investing, knowledge is power, and the more you know, the better decisions you can make. Today, we've explored the complex world of hedge funds and explained how they make money. We began by defining hedge funds before delving into their intricate structures. We then illuminated the various investment strategies employed by these funds, which range from long-short equity strategies to global macro strategies and many more in between. We also shed light on the fees and performance aspects, highlighting the typical 2 and 20 fee structure and the importance of performance for these funds. We then ventured into the potential risks and considerations, reminding viewers that while hedge funds can offer significant returns, they're not without their risks and should be approached with caution. In essence, hedge funds are complex vehicles that employ sophisticated strategies with the aim of generating high returns. They're not for the faint-hearted, but for those who understand the risks and rewards. They can be a rewarding investment avenue. Thank you for watching Investor Web. If you found this video helpful, please subscribe for more insightful investment content.